Hey everyone, I know it's time to rush to the CAs to complete your accounts. After all, it's the season for filing taxes. If the income numbers and the tax you need to pay scare you, perhaps this video will be helpful. Today, I have an interesting topic, NRIs in the UAE. Would love to know about. Don't fret, there's no big reveal because you've already seen the title and the thumbnail. But before I dive right into it, you know what to do. Like this video and share it with your friends and your family. After all, sharing is caring. What is DTAA or what is DTAA? DTAA or Double Taxation Avoidance Agreement is a treaty signed by any two countries to ensure citizens don't have to pay tax multiple times in both countries, the one they are from and the one they reside in. Thus, this essentially helps NRIs such as yourselves who live abroad. DTAA usually covers different income streams such as employment, dividends, business profits, capital gain, etc. While India has signed this treaty with several countries, today's focus is on the UAE and capital gains tax on mutual funds for NRIs in the UAE. But why is it so special? If you are an NRI in the UAE, you do not have to pay capital gains tax on mutual fund investments in India due to the DTAA signed between the two countries. Does this mean you'll pay tax on the gains in the UAE? The answer is a resounding no. As per Article 13 of the treaty, any asset that does not come under immovable property, movable property, or shares of a company may be taxed only in the country in which the person resides. This means gains from mutual funds for NRIs in the UAE will not be taxed in India but only in the UAE. However, since there is no tax on personal income in the UAE, NRIs do not have to pay tax on mutual funds, even in the UAE. Let's do a quick quiz to see if you understand this. If a person invests 5,000 rupees every month in an equity mutual fund for 10 years, they will eventually get 11,61,695 rupees if the yearly growth rate is 12%. Now, if the person is an Indian, their gains of about 5,61,695 would be subject to 10% LTCG or long-term capital gains tax over and above 1 lakh rupees, which is a little over 46,000 rupees. However, if you're an NRI in the UAE, how much tax would you pay? Option A, 46,000 rupees, option B, 23,000 rupees, or option C, 0. If you chose option C, you've nailed it. The reason is simple. Due to the DTAA, there is no tax on personal income in the UAE and no tax on mutual funds in India. As mentioned, India has signed DTAAs with different countries, but not all provide these two benefits together. Moving on, let's discuss how you can avail these benefits. Steps to avail CGT benefits. To gain these tax benefits, you must follow below steps. 1. Be eligible to attain the UAE NRI status by living in the country for 183 days. Get a tax residency certificate or TRC. It is important to note that getting a TRC is expensive and slightly more difficult in the UAE than getting one in countries such as Singapore. You can download Form 10F from the Indian Income Tax Portal and submit it to the Assets Management Company, AMC. You must follow one of these two steps here. If the AMC deducts a TDS, you can apply and claim the refund. If it doesn't, you won't need to apply. If the refund claim is rejected, you must rectify the application, file a revision petition, or appeal before a tribunal. But why would the AMC deduct the TDS when the UAE NRI doesn't need to pay tax? More on that later. For now, let's say you missed applying for the TDS refund, then what can you do? For the assessment year 23-24, the deadline for claiming the DTAA benefits was 31st of December 2023. However, if you miss this, you'll find yourself in one of these three scenarios. No scrutiny. In this scenario, income tax accepts your submission. Since you have not applied for DTAA benefits, you'll need to revise the petition. According to Section 264 of the Income Tax Act of 1961, an assessee can file a revised petition against an order passed by the assessing officer or AO. This petition can be filed before the First Appellate Tribunal or CITA. However, if rejected, the assessee can file a petition directly with the Commissioner of Income Tax or CIT. You can file a revised tax assessment file using this section as an assessee. If it is rejected by the assessing officer, you can file a petition in the court of law. Subject to scrutiny. Scrutiny means that income tax officials will examine your file more closely. It is a common situation for people who try to claim a mutual funds exemption under the DTAA. More on this later. If your submitted file is already under scrutiny, you cannot make new claims, such as exemption on the gains on mutual fund investments. You can file a new claim but must appeal to the authorities against that order to avoid rejection. If the claim is rejected anyway, you'll need to file through a tribunal or submit a petition in the court to revise the scrutiny order. An income tax tribunal is a group of people who will assess your file. So you can go through them or file a petition in a court of law to revise the scrutiny order so that you are allowed to make the new claim. Apply to Central Board of Direct Taxes or CBDT. You can apply to refund the claim to the CBDT. Although CBDT is not legally required to accept the revised returns after the deadline, it does have the power to do so. Challenges and considerations. These steps seem tedious and one may wonder if they apply in practical or real life. The answer is yes, but it comes with several challenges. Remember I mentioned the AMCs deduct tax at source? This is because they often do not want to enter into such complex tax arrangements. Several tax officials are unaware of the DTAA and such tax provisions that NRIs in the UAE can benefit from. As a result, your application might be rejected. But what's worse is that you might be under scrutiny and face litigations if you try to claim such benefits from the income tax department, and it would be difficult to convince them. In essence, investors and even CAs must have an in-depth understanding of the treaty, its laws and regulations, and the various clauses involved in such agreements. To help you understand the regulations better, let us look at a couple of cases around the DTAA. Here are some case studies. First, we look at the ITO IT21 Mumbai versus Shri Satish Bihari Lal Raheja. In this case, the individual, who is a tax resident of Switzerland, filed taxes in India and showed a taxable income that didn't involve mutual funds. It is important to note that the two countries have signed the Indo-Swiss Tax Treaty. According to the assessee or the individual, mutual funds were exempt from taxation in India. However, the officer cited that mutual funds were akin to direct shares or stocks according to Article 13(5)(b) of the treaty. The tribunal authorities decided that mutual funds were not akin to shares in terms of the treaty's provisions of Article 13(6). Thus, individual could leverage the tax benefits and needn't pay taxes on the mutual funds in India. Besides this, the assessing officer incorporated the indexation while calculating the capital gains on mutual funds. However, since no taxes were paid, the calculation wouldn't be required and must be removed. In simple terms, the decision was in the individual's favor, as the authorities decided he did not need to pay taxes on the mutual fund gains in India. The second case study we will examine is the DCIT Circle, Kochi versus Shri K.E. Faisal on 8th of July 2019. This case is similar to the previous one, except it concerns an NRI in the UAE. The assessing officer considered mutual funds akin to shares, and the court cited Article 13(5) to affirm that mutual funds and shares are different. The two cases showcase that mutual funds are not taxable in India for NRIs in the UAE and countries with which a similar tax treaty is signed. However, it also showcases that tax officials may not be aware of the intricacies of the clauses, resulting in litigation for an investor. So, to quickly summarize, NRIs in the UAE do not have to pay taxes on the mutual fund gains in India, and since the Emirates does not tax personal income, they do not have to pay tax in the UAE as well. However, the parties involved, including AMCs and tax officials, may not be aware of such laws, might not understand the clauses well, or just wouldn't want to get in complex tax arrangements. Thus, it is tedious to avail of such benefits in real life. But the cases prove that it isn't impossible. Before I leave, remember that any information you receive in the video is not a recommendation and is for educational purposes only. If you found this video insightful and valuable, like it, share it, and subscribe to the channel for more such content. See you in the next video. Happy investing. Bye-bye.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and or other instruments traded on the stock exchanges.